5 reasons not to buy a good company stock. My name is Hamish, and before you go and invest your hard-earned money on that stock that you've been researching, you want to make sure that you've covered all your bases. So in this video, I'm going to talk about 5 reasons that you would want to hold off on buying that business. Make sure you stick around to the end in this one to learn about a red flag that most investors don't know about. If you're seeing my face for the first time and you're enjoying the content, make sure you subscribe. It helps me out a heap, but for now, let's jump into it. Number 1 is the price of a stock is higher than its value. Now, I talk about this a lot in all of my videos, so I'm just going to cover it really briefly. But essentially, if you use a strategy like the one I teach in all my videos, where you put a specific value on a business, then you only want to be investing in businesses when their price is 30 to 50% below that value. And the reason we don't want to just invest at the value or just below the value is because we can't be sure that we're 100% accurate in our valuation. So we want to make sure that we allow a 30 to 50% margin of safety or even more to ensure that we get the returns that we want if we are wrong in our valuations somewhat. Number 2, a low ROIC. Now, ROIC is return on invested capital if you don't know, and essentially it tells us how effective is management at investing the money that has been provided to them by shareholders and creditors. Companies can raise capital by issuing shares to shareholders, to investors, or by taking on debt from creditors. And we want to make sure that our company or the management in charge of that company is effectively using that money to invest and not wasting it on investments that aren't getting the returns that we require. Generally, I like to see a 5-year average ROIC of above 10%, which means that over the last 5 years, they've been consistently getting a return of 10% on the capital that they have available to them. And as a bonus, I like to see that the 1-year average or the last year's ROIC is also above 10%, but also above the 5-year average, which means that not only have they been able to effectively invest money over a 5-year period, but in the last year they've been improving their effectiveness, meaning that they're getting better at investing that money for us. If you do want to learn more about the ROIC, I suggest you check out my video which is dedicated to the ROIC. It's on my channel and I'll link it up in the description below. Number 3, high levels of debt. Now, high levels of debt within a company should always be a red flag when it comes to investing in businesses. And this is because even though businesses can operate very successfully for long periods of time with a lot of debt, it makes them inherently a lot more risky. If interest rates do start to rise, it means that companies will have to pay higher interest payments, and this can eat into our profits. And this is a serious concern because while a company can just decide not to pay its shareholders, it can just not pay a dividend, it has to pay its creditors in order to not go into bankruptcy, in order to stay solvable. In order to judge a company's level of debt, I use 2 ratios. The first is the current ratio, and this takes the current assets and divides it by the current liabilities. And basically, we're looking for a current ratio that's above 2, which means we've got twice as many current assets or assets that are going to be converted into cash within 12 months. Twice as many of those as we have of current obligations that we have to pay within 12 months. And that basically means that for short-term debts, we are easily able to cover ourselves and we're easily able to pay off those short-term liabilities, and we're not going to find ourselves in trouble in the short term and having to refinance constantly. The second ratio I like to look at is the debt to equity ratio. This is the debts of a company divided by its equity, and it basically tells us what proportion of a company's finances or capital has been financed by debt as compared to equity or shareholders' equity. For me personally, I think it's really important that this number is below 0.5 because that tells us that most of the company is financed by shareholders and not creditors or debt. Number 4, if management aren't significant shareholders. Now, managers will be primarily paid through their salary. However, they can also hold a number of shares in the company that they work for. If senior managers have a significant ownership in the business, it means that their personal wealth depends on their management performance. So generally, I avoid companies where the board of directors don't hold high amounts of shares, or at least if not the whole board of directors, the CEO and the chairman of the board. If you want to find out how many shares are held by the management team of a company, then just jump onto Yahoo Finance and go onto the company's page, and then there's a holdings tab and you should be able to find out which managers own what amount of shares. It's important to note when we're talking about this that having senior managers that are majority shareholders, meaning that they hold very significant amounts of shares, is not necessarily a good thing because while yes, it means that their personal wealth is on the hook, it also means that it's very hard to remove them from that position because they have so much power through the ownership of their shares. So that's something to note, that it's not always a great thing. And number 5, a company that is making too many acquisitions. Now, this is something that not a lot of people look into, and if you're a beginner, it could be the difference between you picking a really, really solid company and picking a really poor company that has the appearance of a good company. If a company is constantly making new acquisitions, meaning that they're buying up smaller businesses to absorb into their business, it could mean that a lot of the growth that's coming on their revenue and their profits is simply from adding businesses to their original business rather than internally growing. This is a bad thing because we want all the components of a business to be growing internally. And a lot of acquisitions can give the false impression of this. Benjamin Graham talks about this briefly in his book, The Intelligent Investor, and he says that he doesn't recommend investing in businesses that are regularly making 2 or more acquisitions every single year. And I would suggest that if you are looking into a company and you notice that they are taking on a lot of acquisitions, they're making a lot of acquisitions for the past few years, then I would recommend looking through the annual report, looking at the specific segments of the business and making sure that each of those are growing and using those growth numbers in your valuations rather than the overall growth. Because at the end of the day, businesses that grow over the long term are able to internally generate profits. They're not just buying up businesses and adding to their top and bottom lines that way. They've got a business model that's really effective and they're growing it from the inside out. And that's what we're looking for. So if you are investing in businesses that are doing a lot of acquisitions, make sure you look into that because it could be the difference between a company that's growing really well internally and really strongly and another company that just looks like it's growing really well. However, they're actually just making a lot of acquisitions and maybe even taking on a lot of debt. That's all for today, guys. I hope you enjoyed this one. I just wanted to talk about 5 reasons you might want to hold off on buying that really great business that you've been looking into. If you did enjoy the video, make sure you leave a like and subscribe. Let me know your thoughts down in the comments. If you've got any video suggestions, leave them down there and I'll be sure to check them out. But for now, I'll see you in the next one. See you later, guys.